Doge is about to explode, and I'm going to tell you why my strategy is calling for a dollar plus this cycle. Now, when we break this chart down, we can see this range, and the top of this range was back in December 2024, the low of the range, April of this year. Now, what I will do is use my Fibonacci, because I use the Fibonacci strategy to mark out the most key levels. These are also pivot points, but when certain levels break, you do get given a certain expectation and a certain bias. So you're going to have these people saying that when you get a dip, there's a certain point it could reach before continuing lower. And this is called a dead cat bounce. So not completely out of the window just yet, but I'm going to explain why I think that this will not happen. I think that Doge will break past this 48-cent high and target a dollar. So at the moment, what I'm seeing down here to signify this bottom is structural changes, because there were lower lows all the way down, and this was our first higher low. And it's the Fibonacci strategy that actually would have helped me and made me aware of that. We can see that there's this key level of support down here between the 886 and 786. That was used as a pivot point, and everything changed from that very moment. This formed a double bottom, an area of support that maintained on two separate occasions. We're seeing characteristic changes because previously those double bottoms kept on failing. There was a chance to make one here because you're coming back down into this level of support, held once, come into it second time, and you have the moving averages here. All it needs to do is break past these levels of resistances from the other sets of moving averages, and there would have been a double bottom. And that happens all the way down. That is what a correction or a dip or a downtrend basically is. Loads of failed bullish patterns. And it sometimes takes weeks to form that bullish pattern and still fails, and you go much, much lower. So this is where everything changed. We're starting to make this whole entire range into a bullish pattern. Just like that, a W double bottom. So with 14 cent and 15 cent holding, it's taking it back to the range high. And there was an initial breakout. If you remember my videos over here, I got those projected targets ready for you. So what I will do now is do that exact same thing. I just wanted a fresh chart because it has been a while since I made my last update, and I'm expecting a lot of you guys to be new around here. So that is where we currently are at the moment. We need to see this level broken, but I'll prepare the target for you. This would be the more conservative target, taking it from the lowest body candle closure. And you can see that on the break of $2.60, there's going to be a target back at 48 cents. Why is this important? Equally, looking at this the opposite way around, if I were to now, this key level of support, that is this level of resistance. It's just upside down, right? Because I'm using the fibs in two different ways. One's measuring a dip, the other's measuring a pump. Now, if I were to flip this chart upside down, and I've measured this dip over here, it goes back to that example I was telling you earlier about a dead cat bounce, which is the fibs tell you a key pivot point, and that is this area over here, the 786, 886. So you can see, if we wanted, ignoring that up is red and down is now green because I've inverted the chart. If we wanted this chart to continue higher, then it would need to break past this level and these would become its targets. But in actual fact, guys, when we reverse the chart to what it should be, that is then saying if this key level was lost, these would be the targets. But because it was held, those are not the targets. And it's the same for this level of resistance up here, 36 and 41 cents. Now, everything's great right now. We've got this bullish pattern. This was held, so we're not seeing these bearish targets. We've got an attempt at the range high. It's about to break past it. That means the next direct target would be 36 and 41 cents. But shouldn't have any expectations beyond that point. Just like when it was breaking down here, we can see all the moving averages were lost. So even more validity that this bullish breakout was false, that we go back into the downtrend, and that means lower lows and lower highs. So why is it not actually going lower than this low? The downtrend failed. So even with multiple signals, the Fibonacci trumped all of those signals. The Fibonacci is more important. It has more strength, more power. So even though we have a bullish pattern right over here, double bottom, targeting above that level, I'm still not personally 100% confident that it's a guarantee. I always take it level by level. But it's a positive because it's suggesting through this double bottom breakout, through the neckline at $2.60, we should project the previous high, 48 cents. And if that is actually met, we have broken past 36 and 41. And you remember my example down over here, when I invert the chart, if you want to see these higher prices, this 786 and 886 must break. We can see those higher prices never came because it never broke. So inverting the chart once again, you're not going to see these higher price targets of $1 if 41 cent doesn't break. I'm very excited that there's a pattern suggesting that this level will break, but I'm going to personally make videos for you guys going through these day-by-day moves, step by step, and of course reanalyzing when we get up to this key 36 to 41 cent area. So what I would say is that if there is a rejection, so let's say we get this breakout and we get up there, if there is somewhat of a rejection, it cannot lose this level. Otherwise, you won't see this target, because this target is only valid when this neckline breaks, and it must maintain above it. So if you see a dip, that dip needs to stop before losing this, and it should actually continue to the target. By that point, you've flipped this into support, and then the target becomes $1 out of that. That is how we get to $1. A lot has to go our way. We really need to take it step by step. You know, if there is a rejection here, it needs to hold that. How do we know it's going to hold? We don't. But this is the sort of path it needs to take to reach $1. Hopefully this video helped. If you do want to get educated, I have an ebook with this in written format using the Fibonacci's, identifying chart patterns, identifying Japanese candlesticks, and the moving average strategy all tied into one. There's a profitable strategy in there, actually trading between golden pockets rather than entering trades in a tougher territory, because there's no guarantees. Remember that. There is a guarantee that if we break out of here, that we're going to get up into this point. Further than that, there isn't. So if you want to learn a strategy where we're trading between levels rather than having the hope that it will just burst through and do something like that, because that is not going to be the case. Take it level by level. There will be rejections. There's going to be times where you start doubting because it can take so long. You might get caught up in a 2-month correction like this and then puts you off totally. But the level down over here, the most important one, maintained. The next low is higher than that. We still have higher highs and higher lows. So the expectation is that it will just burst through. And then the next low just has to be higher than this. And we do technically want it to be above the neckline, 25 cent. And then we will see the 48 cent target met. By that point, you've recovered the reversal wave, golden pocket, 36 and 41 cent. And you will see 69 to $1 as the technical target. Like, subscribe, comment, and share. Book in a one-to-one video call with myself if you find it easier to learn that way. Half an hour, 2 hours, 5 hours, how long you want. Links down below to the shop. I've also got a Discord community with other traders sharing their TA in there as well.